Okay, before we head in, just a small announcement for the applied level. I also don't know how many people are listening today, being that it is Super Bowl Sunday. Probably be one of the lower weeks for viewership. As it stands right now, anybody who has any CFA status, meaning that you've got level 1, level 2, level 3, or full charter holder, anybody who's got any CFA status, there's a discount already coded into the applied level of $100 off of each module. There are two modules, applied analysis and applied asset management. So if you can demonstrate that you have any CFA standing at all, you've passed your level 1 exams, great. $100 off each one, so you're down to $325 on each one. And if you are a subscriber on mm.com, if you are a CFA candidate, and you also have the CFA program, take another $50 off of that, so you're down to $275. That's already coded into the site. You don't need me for any of that. We've already got all the code in there. I don't have to give you any kind of discount code at all for that. You just go ahead and do it. Starting today, we're going to open it up for any FRM or CAIA status. Also, any university status, whether you are an undergrad, a graduate, or have graduated. Undergrad means you haven't got your degree yet. Graduate means you got your first degree, but now you're doing a grad school, whether it be a master's or a PhD, and then graduated means you're done. You're not in the CFA program at all, but you do have some university status. We will extend the same discount to you, $100 each, so you'd be at instead of $425, you'd be at $325 for either applied analysis or applied asset management. And in about a week, our Discord server will be up and running, and we will start to bring people into the Discord server. So it's only a matter of time before the comments section under YouTube will disappear. Actually, it probably won't disappear, but I probably just won't answer any questions on it. Maybe I'll just leave it there and it'll be what it'll be. But I'm hoping to move the conversation over to Discord in about a week. It's going to take a long time to get everybody there because we got a lot of applied level subscribers, and hopefully we can get a good collection of undergrad students to start contributing to the conversation there as well. Okay, let's head in and see what we have. One more thing about this part here. While the CFA, if you have any CFA status, it's coded into the site already. It is not coded in for any of this. So email me directly for a discount code. I'll give you a discount code that only works once. So once you use it, it's kind of like a gift card. It's used up, right? meldrum.b.m@gmail.com. Email me. I will ask you to, demonstrate that you are. That you do have some status. If it's university status, it's enough to email me from your university email, because it'll be at whatever.edu. I'll see it, and you can only have that if you are affiliated with that university. So that's proof enough. But email me if you want a discount code, and I will provide that to you. Let's have a quick look at the jobs report first, which came out on Friday. 143,000 jobs were added, 111 in the private sector, 32 in government. Let's just get to some of the tables here. The household survey is not going to be of much use to us because of all the revisions, and this explains a bunch of the revisions that were done to population count, labor force count last year. So our January numbers are not going to be comparable to December. So not until we get to February will we have comparable month over month. So this is, for example, 161.6 in terms of employed, 163.9, suggesting 2.2 to 2.3 million month over month. It's not comparable. So these are, if you're wondering why these are all left blank, is because January cannot compare to December. So we go right to the establishment survey. 143,000. We can see here for goods producing, 0. 111 private, 0 in goods, all in services, and of that 3 was retail, 66 was healthcare and social assistance. 100,000 of the 111 in two categories, and government sitting at 32. Average weekly hours down to 34.1 from 34.2 and 34.3 the month before. Average hourly earnings up to 35.87. The month over month is 0.4762. I don't like using average hourly earnings as a proxy for wage inflation because it captures it wraps it up with the mix of jobs as well. You would expect some jobs to pay more than other jobs. That doesn't mean there's wage inflation. It just means the jobs that were filled during the month ended up paying more than the jobs that were lost. It could just be something like that. But if you like to use it as a proxy, 0.4762, running about 5.88%. As far as a proxy for aggregate demand, it's the combination of how many hours you worked and what you got paid per hour. So it is the weekly earnings that matter, and that is up 0.1826, 2.21% on an annualized basis on average weekly earnings. However, let's just scroll down here to, I believe it's table 41. And this is average hourly and weekly earnings of production and non-supervisory employees on private non-PAR payrolls. And here is total private, December 103,392, January 103,314. It's actually negative 0.075%. This is production and non-supervisory, actually negative. If we can scroll up here, this gives you average weekly hours for that category. This gives you the count, total private, 110,230, and in January 110,286. So of the 143,56, 56 were added that were production and non-supervisory. The rest were either government jobs or supervisory jobs. So if production and non-supervisory are negative in terms of the weekly earnings they take home, and total labor force is 0.1826, most of that 0.1826, most of the positive increase in average weekly earnings is attributable to government and supervisory, which is the smaller part of the labor force. If production and supervisory are 110,000 and the whole labor force is 166, we see that it makes up two-thirds of the economy, and it is that two-thirds that have the highest marginal propensity to consume. So perhaps the 2.21% annualized is probably a high number on the rate, annualized rate of increase in aggregate demand, given that it is going more towards government employees and supervisory employees, which only make up a third of the workforce. So underneath, I don't think there is that sort of wage pressure that average hourly earnings would indicate exists. Before we go, have a look at this interesting chart. And what do you see? This is the federal surplus or deficit. By the way, Fred looks like it has a neat new little graphical interface here. It's cleaned up, a little bit nicer looking, a little bit more modern. Federal surplus or deficit. And you can see how it's run fairly flat until you get to about the 70s, and then the Vietnam War became expensive, and then suddenly it just became a thing to do. And then under the Democrats, 97, 98, 99, 2000, 2001, you had surpluses over those years. And there is the wars. Up to 2007, there's your financial crisis, and then we start working our way out of that. And then under Trump, this is when Trump got in, down 2017, 2018, 2019, and then of course the pandemic, and here we are down here. But look at the massive difference in this part of the chart versus way back here. Right? Look at the massive difference in that. That's incredible. I'll have more to say about that in a little bit. Time for another market outlook. I'm doing this from a different location in the house because my new desk is in. I've torn down the other one, but the new desktop's like 200 pounds. It's sitting in my garage, and I can't get it in the house, so I had to move my computer setup to somewhere else. I shouldn't have torn down the desk so quickly, but the one I tore down, I need help getting out as well. Hopefully somebody's going to show up today to get that done for me. Let's see, so again, if the sound sounds off or more echoey, it's because I'm in a bigger room here. Let's have a look at our yield curve, and I think we can break it down nicely to two forces. And we'll just bracket this out to, well, I'm just going to stay at the 2-year even though we have an increase on the 3-year. And this is the Fed. All of this is the effect of the Fed, and from on the longer end of the curve, we have Treasury. So not only are we going to have to watch the Fed for where the direction of the policy rate will go, we have to watch the Treasury for the direction of where longer-term yields are going to go. This week reflects two opposing forces. One, the market, I think, adopting a belief that the Fed is going to keep its policy rate where it is for quite some time, that we're not going to see much happening this year. Let's just jump down to the Fed funds futures. We still have 48 basis points in the curve, but they are being pushed towards the third quarter. We see sort of one rate cut there. Q1 slowly getting to 0, which is probably the right thing on Q1. You have a March FOMC in 38 days, 0 basis points, 91.5%. That's from where the data is today and where the Fed speak is today. I don't see a window for a rate cut in March, but I mean, it's February 9th right now. Lots can happen in the next 38 days that cause a rate cut. You still have the March jobs report to come out, and I think that one is going to show a pretty ugly number, because you did get a hiring all through February reflects the new administration. Government hiring freeze, and how many government employees are taking buyouts. Now, it's 8 months, so maybe that might not reflect in the job numbers, but there might be some some reluctance to hire because of the threat of tariffs, maybe even at the margin some job eliminations because of tariffs. Especially in tourist areas. So we'll see what happens there, but it might creep back in. But for where we stand right now, the data doesn't suggest it. The long end of the curve was Besant twice last week suggested that they're not interested in forcing the Fed to lower the policy rate. That really doesn't do anything. They're interested in the whole yield curve, getting the rates down, not the policy rate, because that's not really a rate. It's just a target. But getting the whole yield curve down, and he specifically mentioned the 10-year, and I've said this before, it's the capital market curve that you have to worry about, not the Fed funds rate, because everything is priced off the capital market curve, not the money market curve. Interest rates on mortgages, on car loans, all of that stuff is priced off the capital market curve, whether it be the 5-year for auto loans, the 10-year for mortgages. And that they're more interested in that. So you're seeing the effect of Treasury on the long end of the curve and the effect of the Fed on the money market part of the curve. It's starting to bleed into the 2-year. Let's have a look at the 2-year. I find this very interesting here. 4.29 on the 2-year. The effective federal funds rate is 4.33. In other words, it is 4 basis points below the effective federal funds rate. That over the next 2 years, the market is seeing 4 basis points of cuts, because 2-year, right? It's got a 6-month coupon, a 1-year coupon, 1.5, and then you get your bullet payment in 2 years. You take your yield curve and you extract out spot rates. If you had a flat yield curve of 4.33 all the way out to the 2-year would have a yield of 4.33. It has a yield of 4.29. That's expecting an almost flat yield curve out to 2 years. 4 basis points, right? The 3 months is at 4.35 with the effective federal funds rate of 4.33. You get to 4.33 on the 2-year. that is basically saying, the 2 years saying, we see no rate cuts. It's factoring in no rate cuts for 2 years. That's incredible. But that belief is slowly creeping into the market that the Fed is probably going to be on hold for a period of time because of one word. The one word the market doesn't like: uncertainty. Uncertainty about, the big thing is uncertainty about tariffs, uncertainty about the effect of deportations, uncertainty about the effect of a significant drop in people coming into the country, uncertainty about the level of government spending and the effect that DOGE may have, because every dollar DOGE saves is a dollar of aggregate demand taken away from someone else. If you had a balanced budget, it wouldn't be that way. If a dollar saved meant you can reduce debt by a dollar, then it also wouldn't mean that, because that just means somebody else has the dollar. But when you save a dollar and the result is you don't have to issue an extra dollar worth of bonds, that dollar just reduces aggregate demand. So any savings right now is just a reduction in aggregate demand. There's a lot of uncertainty on both the job side and on the price side. So that's the message from the Fed last week. We are in no rush. If I were on the committee, I would say the same thing. With this level of uncertainty, we're in no rush. Let's respond to bad events if they show up. If they don't show up, then let's just stay where we are. So, and then Treasury sitting over here now. The Treasury and the Fed, at least with Janet Yellen, and so far Bessent has confirmed that he has had lunch with Powell as well. Every week they have lunch once a week to discuss whatever they discuss. If the focus is not going to be on the policy but be on the rates, we have to pay attention to the SOMA, which is the assets the Fed had purchased. 6.379 trillion, 2.2 trillion of that is agency MBS. And the Fed has, 2 years ago, said they want to reduce the agency MBS to zero. That at some point they see selling the agency MBS and moving that into treasuries. So how much dry powder do you have here for the Fed to buy the long end of the curve? 2.2 trillion. And it could be that the pressure on the Fed comes through Bessent to Powell at these weekly meetings saying, look, he's going to leave you alone on the policy rate. You want to get rid of this agency MBS anyways. Let's move it into the long end of the curve. Let's deliver lower rates for the market, and you know, you will escape the wrath of dear leader. When you look at the RRP, the reverse repo, you're down to 95 billion. Once that hits zero, the runoff starts coming out of reserves, and they're going to want to slow that down. They're going to want to slow the runoff down. So I don't think it'll be long before they start having a conversation about stopping the balance sheet runoff and then selling off the MBS to buy the 10-year. Selling that much MBS, 2.2 trillion, is not going to work out well for the MBS market. Look for spreads to widen on that one. But I seem to think that is the direction that the administration is going to take, is pressure on the longer end of the curve as opposed to pressure directly on the Fed. I think Bessent probably backed Trump off of that, saying, look, you pressure the Fed, you pressure independence, Wall Street will react in a whole bunch of negative ways. Let's focus on the curve. Let's focus on the rates. We have the ability to do something there. Let's be very public about the money we're saving with DOGE, and let me talk to Powell about the long end of the curve, because they do have to get something done on that respect. 38 days to the next meeting. We have 10 days to the Fed minutes, being that we have no tariffs yet. That will be interesting. Powell testimony Tuesday and Wednesday. That will dominate the airwaves for Bloomberg. We'll switch over to that. Bloomberg will probably just hand it over to that, and we'll listen to 3 hours of testimony on Tuesday. You have Congress and the Senate. CPI on Wednesday morning. That's going to be a big number to watch. I don't feel good about this CPI. The CPI will reflect January. I don't know if it's enough information I think it may also reflect increased demand to front run any potential tariffs, because we know that was going on, which means less pricing pressure to the downside. So I don't know if we're going to get a nice clean read on that CPI. And then you have PPI in 4 days. Retail sales in 5 days. And you have some Fed speak this week. Hammack, Bowman, Williams on Tuesday, Bostic and Waller on Wednesday. Reverse repo again under 100 billion. The lowest was 78 billion. That was February 5th. Last week, it jumped up to almost 200 billion. I said that is common at the end of the month, that money sits in money market funds at the end of the month for balance sheet window dressing, and then it goes right back out again. Reserves at 3.2 trillion. Runoff is still 40 billion a month, 20 months to go. If you continue on, if you assume that 2.5 trillion is somewhere around ample, soon as this hits zero, this is going to start decreasing every single week. And I think they want to avoid the speed at which reserves decrease. The reverse repo right now is sort of the canary in the coal mine. When that canary's dead, I think they're going to start talking about evacuating that coal mine. For the Fed funds futures, we got 48 basis points still in the curve. That's 2 cuts in 7. My base case is still 3 to 4, if not more. TLT had a fairly good week, up 1.72. Gave back on Friday. SPX a little bit negative. I've been noticing this on the 10-year. The 4.5 seems to be not just an attractor point, but a sentiment shift point as well. I see this with IWM when the 10-year starts pushing down below 4.5, 4.49, 4.8, 4.7, IWM gets a good bid. Above, when it starts hitting 4.5, 4.51, 4.52, IWM, the small caps, get into trouble. So there's an interesting relationship there, that if you push much above 4.5, you have to be very cautious on equities, even negative on beta and duration. But under 4.5, it seems that you can be a little bit more aggressive in equities, and I've noticed that IWM will appreciate by more than SPX does. Above 4.5, it drops by more. I don't know how long that relationship will hold, but if you think that the 10-year is going to 4%, then being long the small cap seems to make sense. But if you think it's going to 5%, you got to be short. You got to be short the small caps. I think we could look for more of this kind of interesting twist going on in the yield curve, where the short rates are rising and the long rates are dropping. That is a twist going on. And have a look over here. One more thing. We have a curve inversion. The 3-month to the 5-year is now re-inverted. Look at the 2 to the 10. A drop of 16, only up by 20, or upward sloping by 20, and the 3 to the 10 by 14. You get more pressure on that 4-year. You start seeing 4.35, 4.34, you get an inversion, a double inversion, the 3-month to 10-year, and then your 2-year may follow. Now, I don't know what that means, because a curve inversion usually meant one thing, and that never happened. Double inversion is pretty rare and pretty damaging, but is it going to mean anything? It could this time, because you don't have a Biden administration just pumping out deficit spending. Now, we haven't seen the budget this year. Could be that the Republicans are going to push out deficit spending. I don't know. But there's that word again, uncertainty. We're going to spend some time on beta this week and look at the effect. There was a couple of interesting data points about the retail investor. And we'll look at one story I got from Morningstar, but I think it was from MarketWatch. I think it was just copied. We'll look at one story there, and then we'll look at some valuations for large, mid, and small cap. Let's look at SPY, our forward 4-quarter operating earnings. Significant drop, 272.77 down to 271.24. A slight pullback in the SPX. Still sitting at 22.2 times forward earnings. 22.21, an increase from last week. Even though you had a slight drop, you had the drop in the numerator on a percentage basis was larger. Implied volatility still elevated but drifting away, and on TLT actually increased week over week. Implied volatility on TLT, the last read was 14%, 12.8 on SPY. Put call open interest dropping a little on SPY to 2.51, and still very low on TLT. As far as levels go, January 23rd sitting at the all-time high of 609.02. With this heightened uncertainty, with the threat of tariffs on everything that moves, I think that's his one tool. It's like a kid with a hammer, right? Everything is a nail. I don't know that that's going to work out well unless he actually pulls the trigger on someone. But so far, it seems that he threatens it to not get much more than he already had. I don't know. But you still have tariff uncertainty. You have job market uncertainty. You have, I don't know if you know how real it is, but the idea of U.S. expansion into other territories. The U.S. wants the Gaza Strip. How do you push a market higher with that level of uncertainty? So this is, unless we get this uncertainty solved, I think that is sort of a big headwind, and you have a lot of resistance, beginning to build up at that level. With the closing price down 1.44%, small caps even worse. IWM and IJR. It was late November when they hit their highs. The Russell 2000 down 6.7% off that high, and IJR down 7.53% off that high. Both had negative weeks as well. The IWM was down a little less than SPX was down. We have earnings this week, 78 and 76. Again, I think that's the best that we can hope for. They're the same for every single day of the week except Monday. LSEG points to two more companies that are reporting Monday. Big one being McDonald's, I think, that they had, where Sector Spider didn't have that. So let's have a look at who's reporting earnings, and then we'll spend some time thinking about beta. Okay, on Monday, on semi in the technology space, McDonald's in consumer discretionary, and we have Lowe's as well, not on this list. On the 16th, DuPont in the materials sector. Anything interesting here that we pay attention to? Supermicro, if you're watching the headline companies. Coca-Cola, Humana, Gilead. On the 24th, nothing interesting. I say nothing interesting that I really watch, or that is big enough that's a headline company. You have Kraft and Cisco, and utilities. You've got a few there. CVS. I think the more interesting utilities are on Thursday here. Deere, that'll be an interesting one. Ingersoll Rand, Palo Alto, Applied Materials. The cybersecurity firms have been doing quite well this quarter. So let's see, Palo Alto follows through, the largest in that space. And for utilities, you have Duke Energy. I'm looking forward to that one. I don't have a position in Duke, but they own half of Florida. NextEra owns the other half of Florida. NextEra just hasn't been performing very well, even though their earnings were pretty good. And I think it has to do with NextEra Energy Partners cutting their dividend. They've changed their name. They have a different strategy. But maybe Duke and their forecast, any guidance they give is, that's for the state, would benefit NextEra. Maybe NextEra can get a lift off of that one. Continuing on, we've got Pool Corp, Wynn Resorts, Airbnb. I do use Airbnb, and Moderna on Friday. Last week, I had heard on Bloomberg an analyst say that the retail investor has been the one participating in most of the buy the dips for this year, and the institutional investor has sort of been sitting back. And then I heard it in a couple more places, and then this story showed up on Morningstar's site, but it is a MarketWatch story. A retail army is bullying bigger investors waiting to buy a stock market dip, says Goldman strategist. I underlined some things. I think it's worth reading the whole thing, but we're not. According to Goldman Sachs Florida-based tactical strategist Scott Rubner, who told clients in a note on Wednesday that a record retail army is new and was not on my bingo card, there is competition for dip alpha, and civilian investors, I like that word, civilian investors, have been pushing around institutional investors given the rally and inability to break lower in equity spot prices. Data show retail investors bought those pullbacks. It talks about a couple of the pullbacks, and that data is showing that retail investors have bought them. Rubner explained that their data set tracking retail buy imbalances, that is when more investors are buying than selling, showed a record imbalance of $5 billion on January 17th. That was the biggest since 2019 when they started tracking that, and includes the COVID period. Second biggest retail, and these are retail imbalances. That was the biggest. Second biggest was Monday, this past Monday, 4.89 billion. Fifth biggest Tuesday, 4.23 billion, and these are retail imbalances, buy imbalances. The fact that 4 of those took place in the last 2 weeks showed those animal spirits alive and well for retail investors who jumped at the chance to buy stocks as they fell, even if the drops weren't massive. And it's not just retail demand that's providing a tailwind for stocks, but massive corporate buybacks coming into play. We estimate that 60% of the S&P 500 corporates will have an open repurchase window starting on Friday, because the earnings season are over for quite a few of the companies, so they can engage in repurchases again. This demand dynamic switches on in full force next week. You have another 78 companies reporting next week, and you're almost at the tail end of the S&P 500, so that opens them up to repurchase again. Companies buy back their own equity, it drives up demand, push shares higher. 2025 is shaping up for a blockbuster year. Who says Goldman's corporate traders estimate that in 2025, companies on the S&P 500 and Russell 3000 will buy back a record $1.16 trillion worth of stock, averaging $4.64 billion per day. Usually at the end of bull markets, the retail trader is the dominant trader. At the end of bull markets, the institutional trader sits back and waits. Retail traders are weak hands, which means you can expect a lot more volatility if this is a market top and it's a majority of retail traders that are playing along, because they bail very quickly and they jump in very quickly. Whereas the institutional investor usually doesn't bail that quickly, holds on and rebalances, but doesn't just buy and sell. So if this is a top, you usually see a lot of choppiness at tops. We are seeing a lot of choppiness now. You're seeing a lot of retail buying going on. That usually doesn't end well for the retail investor. I think the statistic I heard this week was like 85% of retail investors end up losing their money. 85%. Oof. Okay, on the screen I have bottom-up aggregate estimates, earnings estimates. S&P 500 is your first chart. S&P 400 is your second. The S&P 600 is your third, and the Russell 2000 is your fourth. Here is the corresponding ETF for each: SPY, IGH, IJR, and IWM. I have the implied volatility on each of these. The last look for implied volatility, this is from the options, 12.8, increasing to 15.4 on the mid cap, 17.4 on the small cap, which are profitable and unprofitable. Well, I shouldn't say unprofitable. A large percentage of them are unprofitable. There's some 1,800 companies in that index, 1,850, but 40% are unprofitable. Implied volatility 19.3. And we get a growth percentage here, our growth in earnings. Here is calendar year 2025. The expected growth in earnings is 10.24. The forward PE is 22.4. We can calculate a PEG ratio for the index itself, 2.15 on SPY, 1.48 on the 400s, 1.099 on the small cap, on the 600, and look at this, PEG ratio for the Russell is below 1. So if we're thinking about growth at a reasonable price, the S&P, if we think 1 is a fair price on a PEG ratio, meaning that the multiple is equal to the growth rate, you have an overvalued large cap, somewhat overvalued mid cap, fairly valued small cap, and an extremely undervalued Russell 2000 from a PEG ratio perspective. But look at these growth rates that are being forecasted for 2025. Q1 growth rate in earnings 28.09%. Q2 being 40% higher than the year before, 53%, 45%. Those are massive growth rates. So that the calendar year earnings 42.65% above calendar year 2024. A forward multiple of 26. So I'm got a big question mark on whether or not that's a reasonable number to look for. Q4, we're getting Q4 earnings now for 2024. The growth that was expected, 6.93, actual coming in at 7.4. So I don't know. It's whether or not you believe those massive growth rates going into next year. If you have a 10-year that's going to be above 4.5%, 4.5 or higher, I question that. I think if you have a 10-year that pushes down to 4% and even down to like 3.75, perhaps. But I'm just not seeing it. I seem to think tariffs, and especially retaliatory tariffs on the U.S., would hurt the small caps more than the large caps. If we're looking at multiples to determine what looks attractive, you have 22.4 forward earnings on the SPX on the 500, 26 on IWM, but you're down around 16 and a half on both mid cap and small cap. So on a multiple relative basis, they are cheaper. If we look at the S&P 500 small cap, it has the best of both worlds. It has a PEG ratio pretty close to 1 and a multiple of 16.4. And if we look at where it's sitting now, it's down 7.5% below its all-time high closing on November. Down more than the Russell and down significantly more than the SPX. Retail investors buying the dip are focused here. Part of that story, if you go back and you read that story, is that the majority of that money is in the big names. The Mag 7 names. So it is more likely showing up in the large cap than it is in the small cap. So perhaps there is, if you are thinking about a 1 or 2 or 3 year holding, the IJR looks attractive on both a PEG ratio and a forward multiple basis. IWM looks really attractive on a PEG ratio, but has a 26 times forward multiple. They're both small cap indexes, so 16.4 for profitable, 26 for a certain amount of unprofitable, right? It looks like IJR seems to be the nicer one. If you're playing options, IWM seems to be better if you want to collect premium, 19.3 versus 17.4. I seem to think that this is a nice place to sit if you want to add long beta. If you're interested in saying, well, listen, I got to add beta somewhere, I don't know where to add it. IJR looks like a nice combination of pretty good implied volatility versus SPY, far better PEG ratio, a far lower multiple. It's kind of attractive, isn't it? Again, IWM, for those that are looking at IWM at the 0.609 saying, well, that's a lot better. You still have a forward, even with these growth rates. If you can get these growth rates, you got a forward multiple of 26, coming off a forward multiple of 37 for calendar year 2024. But, you do have the evidence that the actual earnings of the 414 that have reported are coming in higher than the expected growth rate. There's 1,428 left to go, whereas for the SPX, I think some 350, 360, somewhere around there have already reported. It's well over 50%, whereas this is well under 50% still to go. So we'll see how this evolves over time. I'm just having a hard time with these growth rates. If you have a 10-year that's sitting at 4.5 to 5, I'm having a hard time accepting those growth rates. So I don't know that this is reliable. These growth rates are a little bit more in line. These are profitable companies to begin with. I'm more inclined to believe these growth rates than I am to believe these growth rates here. So I'd probably, if I had to pick one for long beta, I'd probably say IJR. If I feel that there's a good news coming, I know I'm short IWM, that if I had to get neutral very quickly, I probably would add IJR. This screen here is just some general notes I had. It's not really well thought out. I was just starting to make notes on the themes I think going forward that I'm going to have to pay attention to determine allocations. Number one is DOGE. Number two is tariffs. I had said several weeks ago that I think the monetary was going to take a backseat to the fiscal. No one is anticipating the Fed's going to do anything in March. I don't think anybody really cares at this point. The Fed speak is kind of all the same. We're in no rush. Same story. But the flood of information every day coming out of this administration about what DOGE is doing, about who's next on tariffs and who's being threatened today with tariffs, that's getting a little bit tiring. He's got to pull the trigger on tariffs on more than just China, or this is going to be just empty threats. He's got to pull the trigger on someone. I think part of him knows he's got to pull the trigger on someone. Canada and Mexico really just delivered to Trump what they said they were going to do anyways. And for Mexico, it was pretty much what they were already doing. So didn't get very much on that. So that's finding its way around the media as well, that Trump really didn't get very much out of that. He's going to have to do something or he'll just be considered a blustering buffoon, and it's just something that he threatens, but he doesn't mean it. Let's start here with DOGE. They're looking for spending cuts. Last week, watching the press conference, the press secretary called out Politico in the room and said, "You guys are getting $9 million from the taxpayer," and then proceeded to call on the back row of alternative media who never get called on and who don't get any funding. I think that was a pretty bold move to call them out right in the room. You're bringing the message to the people. You're not trying to find a resolution in Congress on this one. It's almost like a hostile takeover where you're going past the board of directors right to the shareholders and saying, look at the wasteful spending of your shareholder dollars, your taxpayer dollars, $9 million for this. And then it started leaking out about a whole bunch of, $3 million for this silly thing and $5 million for that silly thing, on and on. It doesn't look good. If you tell me a government spending $1, I'll tell you there's waste in that dollar. Everyone knows that. Everyone knows that. But what is called a transaction cost in business is called waste in government spending. That's the transaction cost. Is you want my vote for this bill? I need something. And my ask is really small. It's a $20 billion spending package. I need $5 million for something. Come on. And you got my vote. And somebody else says, well, I need something for mine. Pretty soon you're spending $23 billion to get $20 billion of good stuff done. $3 billion will be, well, that was the transaction cost. Much like you buy something from Amazon, you pay shipping. Or you pay for Prime. Either way, you're paying a transaction cost. There is some leakage in the system. That's politics. Could it be that if you start cutting all of those things, you make the good things harder to do, because you're trying to get the transaction cost down to zero, and transaction costs are never zero. Either way, there are going to be spending cuts. I don't think Trump really cares or thinks very deeply about the relationship between the waste to the good stuff and thinking about it as transaction costs. There will be spending cuts. That is positive for yields because you don't need to borrow that much money, and if you can move that deficit spending in the first year from negative 1.8 trillion, even if you can get it to like negative 1.3, that will be very good. With a plan maybe for negative 800, then negative 3, and maybe a surplus in the final year. Also, it's negative for aggregate demand. So let's take political. They get 9 million. You have deficit spending, which means you had to borrow to get that 9 million to spend. And if you were borrowing, you're taking it from savings that wasn't going to be spent to give it to a channel where it is going to be spent. That's aggregate demand. If you take that away, you reduce aggregate demand by that 9 million because you don't need to borrow another 9 to keep funding this. You're already in deficit position. It'd be different if you were in surplus, but you're in deficit position. So that is just a hit to aggregate demand. So every dollar they save in spending is negative for aggregate demand, but positive for long-term yields. Negative for aggregate demand, maybe the monetary becomes more important. If we start seeing a drop in aggregate demand in a lot of places because of some of these policies. But that chart I showed you of deficit spending, you can't continue on like that. You simply can't continue on and hope that the outcome is going to be good for everyone. That is not in the common interest to run a deficit like that. It may be in individual interests. And this is sort of what Plato warned about. Believe it or not, he called democracy a perverted form of government. He said, with democracy, what you get are decisions that are in the benefit of the many, but not in the benefit of the common good. It's kind of like letting your 4 children determine what their menu is going to be for their meals. It'll all be desserts and candy. Well, that's the desire of the many, but it's not in the benefit of the common good, right? So Plato warned that if you let people determine what is good for them and government deliver not what's good for them, but what they want, it's not necessarily good for the common good. I'll just say it. Terrible sentence structure, but I'll just say it. You can't continue on like that there has to be some pullback in that, and to get some pullback in that, there is going to be some drop in aggregate demand. What I did was I went back to the deeper part of these deficits, and I baselined a year, and I said, okay, well, let's assume that we take a given year, 20XX, and we baseline that, and then every year we look at the increment in GDP over that, and I tried to make them all equal blocks as much as I possibly could, and I took out all the deficits. And then I adjusted it for inflation. So I took the base year and I said, well, if you got zero growth and you only had inflation, this is where you would get to. And then you add your deficit spending. That is a difference between the deficit you had the year before. And you keep doing that until you get to the end of 2024. And then you look at what the underlying real GDP was over that period of time, 1.51% over a long enough period of time. The SEP from the Fed has it at 1.8% as potential GDP. We think that we're running a surplus at 2.5 to 3%. But if you take out all the government deficits over the last 10, 11 years, you actually get to an underlying growth of 1.51%. The 1.8 is probably a correct number. That if you start moving your deficits towards zero, you will start moving your GDP down towards the carrying capacity, it seems, of 1.51%. Now that's 1.51 with assuming you had balanced budgets over that period of time. So if you do get to a balanced budget, your GDP is much lower. And that goes to the point that your spending cuts up here are aggregate demand cuts over here. Let's see what happens here, 14th. But the stories coming out of this seem to be positive for for yields. That if there is that much waste, how much can you save? How much can you save on this? There's fact, and then there is what the Trump administration says it is. Sometimes those things match. Sometimes they don't. As an example, Marco Rubio said, Panama has agreed to let our Navy ships go through the Panama Canal for free. And Panama leadership came out after and said, we never said that. We said we'd study it. We never said you'd get it for free. So it is a matter of, you don't have to have a victory. Just say you had a victory and then accuse the other side of reneging on the victory. Now that will escalate. Let's look at tariffs. What is it now? Tariffs on Canada and Mexico. Okay, no tariffs on Canada and Mexico. Tariffs on China. What is it now? Well, reciprocal tariffs. Let's do reciprocal tariffs. Okay, well, I can understand reciprocal tariffs. That is saying that you take two countries and this country has a tariff on this country of 20%. Well, okay, 20% back. Reciprocal tariffs. So that if a country has no tariffs on you, you have no tariffs on them. That seems to make a lot of sense. You got to be careful, though. Some countries have tariffs because that is their form of income. Take Costa Rica, for example. It's 30% on everything coming in, 100% for vehicles because they have no domestic production. They export pineapples, really, and avocados. That's about the maximum. They import everything else, but for a lot of people there, if they're a territorial tax system, so you only pay tax on the money you make within the borders of that country. So if you live in Costa Rica, but all your income comes from outside of Costa Rica, you pay zero income tax. That doesn't mean they don't have tax. All their tax comes from the import duty. So if you then reciprocate on them, I don't know that it would have that much of an effect because, again, there's very little domestic production in Costa Rica. They export, a little, just a small amount. But it would increase the price of pineapple at Costco because if you look at your pineapple at Costco, you'll see product of Costa Rica. Depending to the extent that you're not ordering your avocados out of Guatemala, it'll increase prices on those as well. But there are some countries who have tariffs because it is their source of income, not because it's to protect any local industry or punishment. Anyways, they have identified some countries they call red zone, yellow zone, and then others, red zone, China and India. China has already reciprocated. We'll see what happens here. India has already lowered tariffs this past week in anticipation of this. I was surprised to see the tariffs they had on vehicles. They call a luxury vehicle anything landed that is over $40,000. And it was fairly high. They've lowered it to 70%. I think there's some other duty that goes on that, some other tax that goes on it, plus 70%. I'm sure there are people in India listening. If you could maybe clarify that for me. I couldn't quite figure out if there were two taxes on it, or if 70% was the original and now it's cut in half, or it's cut down to 70%. I don't know, but India does have some high tariffs on products coming in. Yellow zone, EU, Thailand, Taiwan, Vietnam. I don't know what you're going to get done here. You need the importation of the semiconductors out of Taiwan. I don't know what you're going to get done there. And then maybe Japan and Malaysia. So I think what the outcome of this is, of these tariffs, are going to be is either reduce your tariffs on us or buy some stuff from us. And maybe it's energy, maybe it's natural gas. I don't know. And then, of course, Mexico and Canada, March 1st is the deadline. That's a 28-day deadline that he sort of gave, I think 28 days or a month, or call it March 1st. Both Canada and Mexico have demonstrated a willingness to reciprocate. So, a bully wants to punch you, and that's it. A bully doesn't want to punch somebody who's going to punch him back, even if they can beat him up. They still don't want the trouble. They just want to bully people. I don't think Trump is going to do anything with Mexico and Canada. The retaliation would be on red states from both Canada and Mexico. They would focus their attention on a few red states and try to break those red states, because you can't, as I said before, you can't beat the U.S. at this game, but you can focus on one part and break it. And I think that's enough pressure for Trump to back off on that. I don't see. I put a low probability on tariffs showing up on Canada or Mexico. I put a low probability on that. But we do have this, and we do have this, and this has been blocked, which isn't going to work out well. It's mostly from Democratic attorneys general. Well, you still got to defend that. And on top of everything, you have some tension with the new Time magazine cover showing Elon Musk as the sort of the president there. I don't know if you were watching the press interview from inside the Oval Office, where a reporter asked Trump, "What is, have you seen the new Time cover where Elon Musk is sitting behind your desk?" And he said no, and then he just looked straight down at the floor, and you could see him. You could see that it bothered him. And then he says, "Is Time magazine still in business? I mean, I don't even know." I guarantee you that was the first thing he asked for after that press conference was done, was that cover, and he was fuming all weekend long. Twitter was full of just comments of, "Oh, he ain't gonna like this." It was everywhere. Why? Because everyone knows he's not gonna like that. He does not share the cover. He does not share the stage, and to put him behind his own desk. Ooh, let's see what the fallout from that will be. I'm sure he'll play it cool, but behind the scenes, it's probably not a good thing. All of this comes down to one word: uncertainty. And when there's uncertainty, you need higher risk premiums. You can't sit on a 22 to 23 times forward multiple on the S&P after seeing this earnings season where the bigger companies seem to be getting punished. You're still sitting at 22.2 times forward earnings with heightened uncertainty. I just can't see how a long position in beta makes sense at this point. I heard one analyst suggest that we have seen the highs for the year. Not really saying a bear market, but that this is the highs for the year were already seen. I'm not ready to say that yet, but I seem to think from where we are, lower would probably be the path of least resistance before higher. And that's all I have this week because of this word, uncertainty. That if, gun to my head, what are you going to do? Short beta, long duration. I'm going to continue on doing what I'm doing and looking for these days of massive sell-offs where I can go shopping. Because in the end, I still think we can count on the Trump put on the market. If we're looking at, I'll do it right now, if we're looking at Bitcoin as a proxy for risk over the weekend, because we don't have futures, it's slightly green. So it doesn't seem like there's a lot of sentiment, a lot of negative sentiment. The last 2 weeks, it was just blood red. Slightly green. It was pretty much green all day Saturday into Sunday, just turned red a little bit ago, but still green. So futures tonight should open up, I think, fairly benign. But who knows? Who knows what's going to come out of the White House or what's going to show up on Truth Social, all in all caps letters at 6:22 in the morning, right? Excitement. Anyways, that's all I have for this week.